All right, thank you all for joining us tonight. My name is Luke Shula, as most of you know, and tonight I want to cover a topic that I don't think anyone has covered so far, and that is trading gaps in the market. So many of you guys comment yes if you've seen a gap in the market and wondered what that is and why it happened. Please comment yes if you've ever seen a gap in the market. All right. Yes, yes, yes. Like today, yes, there's definitely one today. No, that's all right. Okay, so what we're gonna do is we're gonna go basically on a little journey here, and we're gonna examine gaps in the market, what they are, how you can trade them, and a couple other things about them. All right, so this hopefully will be a shorter webinar, and then you can ask questions along the way and afterwards. All right, so when it comes to trading gaps, what are gaps? Gaps are a change in price levels between the close and open of two consecutive bars on a chart. Okay, so when trading Forex, the gaps that we're looking for occur between the closing price on Friday and the opening price on Sunday. Okay, so whenever the market's closed, that's where the gaps are happening at. So in the stock market, you're actually going to see gaps, sometimes, on a daily basis as the market closes and opens, closes and opens. Now in Forex, the market is only closing once and opening once. So it's closing on Friday and opening on Sunday, right? So what we're looking for is the gaps we're looking for, they occur between the closing price on Friday and the opening price on Sunday. All right. Yes, I will be showing this on my screen. Sorry about that. All right. Sharing screen. Are you guys able to see my screen? Please say yes or no. Okay, awesome. All right, so really fast before I show you the next thing on my screen, let me continue. There's a couple benefits of trading gaps, okay? So you might be asking, why would I be interested in doing that? Most people don't. Most people don't know about it. Why do most people overlook trading gaps? Why are they not looking at that? So a couple benefits. Number one, market opens on Sunday at 5 p.m., which gives you the chance to put on a trade before the work week even starts. All right, so that's pretty cool because if someone's looking for a trade they want to hold for a couple of days, or they're really busy during the week or anything like that, you can actually place it on your weekend. All right, another cool thing about that is that you have the whole entire weekend to analyze a currency pair and set up your trade. Another benefit is that these are the easiest type of trades to spot. All right. Some people on here might disagree with me, but these are the easiest types of trades to spot. Why is that? Because there's nothing to misinterpret. Okay, there's nothing to misinterpret. There's either a gap or there isn't. All right, so if you see a gap in the market, then you know there's a gap in the market. There's no ifs, buts, maybes, or anything. It's either there or it's not. All right, so that leads me to the next thing. If you're taking notes, you can write these down. There are only three things that the price can do from the Friday close. So when the market opens, there's only three things that it can do. All right. Number one, the market can open above Friday's close, which is called gapping up. All right. If the market closes above Friday's closing point, then it gapped up. That's what it's called. I'm going to explain these further as we go. All right. The second thing is the market could open, the price could open below Friday's close, called gapping down. And the third thing that could happen is it could open at the same price as Friday's close, which means that there's not a gap at all. It opens at the same price. Okay, so sometimes that will happen, but if there is a gap, then you will see a space in between the candlesticks, and it'll either be gapping up or gapping down. So now what I want to show you is there's two types of of gaps basically, gaps and full gaps. Okay, so here is an example of a partial gap. And let me explain how you know that it's a partial gap, what exactly that means. Okay, are you guys able to see this? Yes, awesome. Perfect. Okay, so with a partial gap occurs when the opening price, which is right here at the bottom, okay, it occurs when the opening price is higher or lower than the previous closing price. Okay, so see, the opening price of the most recent candlestick is higher than the closing price of the last candlestick. Okay, a partial gap occurs when the opening price is higher or lower than the previous closing price, but does not gap beyond the high or low of the previous candlestick. Okay, so you'll notice that the previous candlestick had a high right up here. Can you guys see where the previous candlestick had, that wick going up above it, and the wick closed, a little bit above here? Yeah, perfect. All right, so looking at the most recent candlestick, it did not open above that point. Does that make sense? So it's only a partial gap because it partially opened over it. It only opened over the wick, but not the candlestick. Okay? So just to read that one more time so you have it clear, a partial gap occurs when the opening price is higher or lower than the previous closing price, but does not gap beyond the high or low of the previous candlestick. All right, so this is a perfect example of a partial gap. So using, pretty much what you heard just now, what do you guys think would be considered a full gap? Go ahead and comment that. How do you know if it's a full gap versus a partial gap? What would that mean? If the price opens above the wick? Exactly. All right, so here's what you're looking for a full gap. All right? A full gap occurs when the opening price opens above or beyond the previous bar's high or low range. Okay? So higher than the closed and past the wick. Exactly. So an example of that would be like right here. All right? So when you're looking at this gap, meaning there's a space between the candlesticks, now you know that there's a gap. What type of gap is it? Well, the opening price, which is way up here, opened above the highest point of the previous candlestick, or the wick right here. Okay, so this would be considered a full gap. So that's the difference between partial and full gaps. Now, when it comes to determining a trend from trading gaps, there's not too much of a difference between if it's partial or a full gap. However, it's good to realize the difference between them. All right. 1, 2, 3. All right. So, okay. Now, in the next section of your notes, I want you to write this down. Gaps are classified into 4 different groups. All right. This is the part, you really want to pay attention here because now you're going to determine where the price is going from looking at the gaps. Okay. So gaps are classified into 4 groups. Those 4 groups are breakaway gaps, exhaustion gaps, common gaps, and continuation gaps. So what I'm going to do now is I just want to go into a little bit of details about those so you can understand the difference. And then I'm also going to show you right over here, right there. Okay, so looking at this, you might not understand exactly why they're labeled as they are. So I'm going to go ahead and define each one, each type of gap, and then explain to you from this chart exactly what's going on and how you could know how to classify it as that type of gap. All right, so what is a breakaway gap? Does anybody know what a breakaway gap is? Looking at my chart here, you might be able to guess. What is a breakaway gap? Anybody? You see it labeled right here as breakaway gap. Okay. Oh. Breaking a trend. Looks like over the weekend. Something breaking away from the normal trends. All right. Yeah, definitely. You guys are on the right track. High increase in price. It could be an increase or decrease. Okay. So with all these terms I'm giving you, in the examples, here, a partial gap, this is this one gapped up, okay? It could have started, down here, and it could have gapped down as well. So all of these definitions, it's either up or down. It works both ways, okay? Just to clarify that. So, all right, a breakaway gap. A breakaway gap occurs at the end of a price pattern and is signaling the beginning of a new trend. All right? Let me say that one more time if you're taking notes. Breakaway gaps occur at the end of a price pattern and signal the beginning of a new trend. So let me show you how that is. You can see these candlesticks at the bottom left of this chart are kind of going up and down, up and down, up and down. And obviously there's a strong, resistance and support line. So you could imagine, some trend lines on here that create a really nice, parallel lines. Or what you call a channel. Could you guys see that? Obviously there's a really, really strong support line down here at the bottom. And then you've got a resistance line at the top. So imagine, support and resistance lines, you created a channel there. And then what happens is this candlestick opens up way up here. And there's a gap in the market. So what it did is it broke away from that trend that you had going on there. All right? So that's why it's called a breakaway gap. That's probably the most simple, the breakaway and common gaps are the most simple ones to spot. So the breakaway gap is really, really easy to see because you're going to have your trend lines already drawn and it opens outside of that, starting a new trend. An exhaustion gap. All right, so the exhaustion gap, these are really tricky ones to spot, but what happens is the exhaustion gaps occur at the end of a price pattern, or in this case, an upwards trend. That's what I mean by price pattern. Yes, Dylan, this is recorded. So you'll notice here from the breakaway gap, it starts an upwards trend. All right, the trend is going up, 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 and then there's a gap in the market way up here. So that would be an exhaustion gap. Exhaustion gaps occur at the end of a price pattern and signal a final attempt to hit new highs or new lows. So what happens is at the top of an uptrend, there's a gap and it makes a new high. And with an exhaustion gap, it actually comes back and it fills that gap. As you see right here, it finally, broke past that point and it retraces, okay? I'm going to get into this a little bit more in just a minute. These are just basics of what is each one. So this would be an exhaustion gap. And then you have common gaps down here. Common gaps can't be placed in a price pattern or a trend because they really don't represent an area where the price has gaps. So common gaps are still within a trend. They're not creating a new high or a new low. All right? And then you have the continuation. Can we watch this video over again after 9? Yes, Jessica, absolutely. I'm recording this and in this website, nesvquez.com. There you go. All of the recordings are also posted there as well, so you can definitely check them out there, starting from our very first ones all the way up until now, so you can get caught up. All right, so the last type of trend, continuation gaps. Continuation gaps occur in the middle of a price pattern or trend and signal, basically what's happening is they signal a rush of buyers or sellers, depending if it's going up or down, that have a common belief in the future direction of a currency pair. So in this case, where it says measuring or runaway gap, those are other names for a continuation gap. So as you see, there's a breakaway gap that begins an upwards trend, and then along the way, there's another gap and it continues going up. So that's a continuation trend. So basically all that's happening here is normally when news or something comes out, something tells people, a lot of people at a very small amount of time decided to buy at that point. And so the market gaps right there. All right. Especially if it's over the weekend, a lot can happen, and those gaps can be pretty large, as many of us have seen before as we trade. All right, so those are some more simple definitions of those. Now let me go into a little bit more details. But definitely realize that, once a gap starts to fill, it will rarely stop doing that. Okay, so with the exhaustion gap, once it begins to fill, it's rarely going to reverse and go back up. And the reason for that is that there's often not an immediate support or resistance. Does that make sense? Especially with the exhaustion gap, because it created a new high. So there's not going to be a lot of support and resistance up here. So when it starts coming down, it's almost always going to continue going down instead of reversing and continuing back up. Does that make sense? Do you understand why it would, once it starts to fill, why it would normally continue? Because there's not support and resistance. Does that make sense? All right, awesome. So another way of putting the breakaway gap is breakaway gaps break out of an area with established support and resistance and creates a new high or low. That's another way of putting it. And you'll notice here when this new candlestick opened after the gap, that's a new high. It created this new high here. And so that's how you can instantly know what type of gap that is. And then the continuation gap occurs in an already existing trend and suggests a continuation of that trend. As you know, that's really, really simple and easy to see. Exhaustion gaps. Yeah, I wanted to add a little bit more about these. It's really, and it's really hard to notice. Sometimes the similarity between an exhaustion gap and continuation gap is hard to spot. But exhaustion gaps are really going to be at the top of a trend. And what happens with those, because they're similar, what happens with those is the gap is filled within just a few candlesticks, as you see. And what happens after that is it will either consolidate horizontally, or it's going to continue in the direction that it was going when it filled the gap. So in this case, when it filled the gap, it was going down. So it's normally going to either, consolidate and kind of flatline, or it's going to continue going down the same direction. Okay. And then common gaps are, they're really easy to see. They just, don't break out of the trading range, and they're very quickly filled. So, you don't really worry or focus about those. You want to trade with the trend. That's really important. These don't create a new high or low. They're still in this consolidation area here. So you really don't want to, get in on those trades as much because there's not much happening anyways. You're not trading with a trend. There's not too much movement in the price, if that makes any sense. If you guys have questions, feel free to ask about those. And then I also have Josh Sanchez on the call, and he wants to go ahead and talk about one of the indicators that you can use and go into some details about that as we move on throughout this webinar. So I know this was really quick concerning gaps, but I feel like a lot of people are not informed on them. They don't know why they happen. They don't know what's going on, and they have no idea how to trade them. All right, are you determining the gaps by the end of one candlestick and the start of the next, or the close of the next? Okay, so you're determining the gaps by the end of one candlestick and the start of the new one, okay? By the start of the new one. So, for instance, let's go here. Euro US dollar, as you guys see, well, hopefully you can see this. As you guys can see here, there's a gap, okay? And what type of gap would this be? Between Friday's candlestick and today's candlestick, is this a partial or a full gap? Partial, partial, partial. Exactly, exactly. And that's because, the beginning of the new price, or the price of the new candlestick, is not beyond the high or the low of the previous candlestick, okay? So that's why this would be a partial. Now, if this candlestick had started down here, where my arrow is right now, if it started right there, that would have been considered a full gap, okay? So I hope that answers that question. Yes, in this circumstance, this is the day chart on the euro versus the US dollar, which is normally, if you want to catch a good gap, it will show up on the day chart. If you only see a gap on the 1 minute chart, what happens is 81% of the time it's going to, how do I put it? If it gaps up, 81% of the time it's going to come down. If it gaps down, 81% of the time it's going to go up. However, if it's on a 1 or 5 minute chart, that gap could be so small that with the spread of your broker, you might not be able to profit by trading the opposite direction. So you really want to go to the day chart to see exactly how big that is. What's going on? Can you show me another example from today? This is the only one that I see from today. Hold on. What are the currency pair gaps? That one didn't. The euro versus US dollar always does it for some reason. These are day chart. No. Let me see if I can find another example. I'm not seeing any other ones here. Euro USD is definitely the easiest to find these on the day chart. But you guys can clearly see right here how it gapped in the market and what's going on there, okay? Hey Josh, are you on the webinar? I don't see you.
Yeah, can you hear me?
Okay, perfect. Yeah. Hey, do you have anything that you wanted to add in concerning gaps before you go ahead and get started? I know you have
Yeah.
other examples of one. Did you see any other ones today?
I actually didn't get around to. No. I was literally just opening my charts a moment ago, and I was looking for some gaps, but I couldn't really find any. But I mean, if anything, for the gaps, a lot of people get really excited for Sundays. A lot of traders that want to, make money on Sundays. They get excited because they say, "Oh, the market's open. Let's make money," and they try to tackle the gaps. That's what I like to say. Is a lot of people try to tackle the gaps, and what happens often is the gaps, something that you guys want to know about the gaps, if Luke hasn't mentioned this already, is that the gaps always have to be filled, that the gaps will always get filled. However, there will be occasions where a gap will not be filled right away. So your chances of making money for you filling in on a gap is there, but you're basically entering on a when you're trading on a Sunday. I think we've gone over this, where you trade on a Sunday to Monday. That's what we consider trap days. Those are the days in the market where you don't want to trade. And the reason for that is, like I said, there's barely any movement that goes on in the market. So would you rather place a trade on a day where the market is barely moving and you don't know what's going to happen to your position, or would you much rather just place a trade knowing what the market's been doing previously and seeing a lot more movement in the market, which makes you feel a lot more comfortable about opening up your position? Right? It would obviously be the second one, because you want to be conservative with your money and you want to maximize off your profits. So when it comes to gap trading, pretty much, as like Luke mentioned, I mean, the gaps always have to get filled, and you don't ever have to really try to gap trade. With gap trading, the only thing that I would say you want to be aware of is the spreads, because when every time the market opens, the spreads are insane. So you look at your broker account and you look at your MetaTrader 4 app, whether it's on your phone or whether you're on your laptop, and you see that the spread starts to go wild because the market literally just opened, and that's when this gaps start to form. Do gaps form on every single currency pair? No, they do not. It's just it's specific currency pairs, different random currency pairs, that actually form gaps at the beginning of when the market first opens up on a Sunday. So that's what I would add on about the gaps, if not mentioned already.
Yeah, I mean, you've definitely covered in previous webinars that Sunday and Mondays are normally not days that we want to trade. But just for, this is, these are educational purpose webinars, and I feel like a lot of people just have no education of gaps and, what, like understanding what exactly they are and why they happen. So me going over this, I definitely agree with Josh here. Me going over gaps and, what's going on with them, the different types, is not saying to trade them, even though they're going to be filled eventually, but it's for educational purposes so that you guys can understand what they are, because I feel like it's not been covered yet, and it's something that's really interesting because every single time the market opens we see these, and so a lot of people, especially newer people, are looking at them saying, what on earth happened, or why did this skip, is there something wrong with my MetaTrader app, or what's going on. And I've had a lot of people just really question that, so I wanted to go over it. But yeah, Josh, I definitely agree. It's not really something that I would try and trade. I don't trade gaps. When I started out, I was scalping the market, and so not only is that riskier, but I was also getting in on every single gap that I could. And sometimes it takes a long time to fill. If your spread is too high, then even if the gap does close, you still might not go in profit. So you have to
Yep.
really look out for that.
Yeah, absolutely, absolutely. I mean, I consider scalp trading, like that's what we say is like when you scalp trade. I mean when you not scalp trade. I'm sorry, when you gap trade. I consider gap trading for people who want to scalp the markets, like literally get in and get out. Only because, like we mentioned, the spreads are crazy, and there's barely any movement going on in the market. As at this point, everybody should know. You know what? Let me ask you guys this, because you guys definitely need to know this stuff. What days of the week are the best days to trade in the foreign exchange market? I want somebody to tell me on the chat right now. What days on the week, on every week, what days of the week is the best days to trade in the market? Okay.
Don't
Yeah.
mess.
Tuesday. Yeah, I'm gonna just take a guess and say that those who just said one day, for example, Thursday or Wednesday, are just trying to get the shortcut that they. But I'm gonna just. Yeah, you guys are right. Yes, Tuesday, Wednesday, and Thursday are the best days to trade in the foreign exchange market because who knows why? There aren't trap days. That's kind of the obvious, brother. Yeah. Um. Yeah. Okay, those are the best days of the week to trade because that's when there's a lot of pip movement, percentage in price. That's what pips is. So that's where the market tends to move a lot, right? And also I noticed that a couple of people mentioned midweek. Yes, absolutely, midweek reversal. That's when the midweek reversal is upon us during the middle of the week, around Wednesday, Thursday. So you'd figure, there's a lot of movement going on in the market. At the same time, you got midweek reversal coming, so definitely something to be aware of, to keep an eye out on. Is it going to hurt you? Absolutely not, because at the end of the day, what you're doing is, like Luke mentioned before, the trend is your friend. You want to trade with the trend until a trend ends. Okay, so you trade with the trend until a trend ends and a new trend forms. So once you understand how exactly do you track. Right. Well, like I mentioned, you're watching a trend. You're pretty much watching a trend throughout the week, and once that trend ends, for example, if you're looking at a downtrend, you see that price has been on going downwards for, let's say an example, right? Let's say GBP, the Japanese, the British pound and the Japanese yen. Let's say that pair has been dropping in the market for Monday, Tuesday, Wednesday, right? And then Thursday the downtrend begins to end and you start to see reversal patterns. For example, you might begin to see dojis form, you might begin to see inverted hammers or hammers form in the market, and that's pretty much giving you it signifies that a reversal is coming, that a reversal is upon us, that the trend is literally going to end very soon. All right. And at that point, you want to start to look for, like I mentioned, this example, we're talking about a downtrend. So at that point, you want to start to look for good buy positions so you can start to catch that uptrend and ride the wave up. You know what I mean? So do you trade London morning breakout? I don't trade the breakouts, to be honest with you. I trade after the breakouts happen. So what I do is I wait for a breakout to happen in the market, and when I see price either shooting upwards or shooting downwards, I say to myself, okay, now I know what this thing wants to do, and now I know that I'm looking for either buys or sells. So yeah, NFP. I mean, yeah, I think NFP happens at the beginning of the month. So NFP, I always tell everyone, even my trade group, like, guys, do not trade NFP if you're not a guru, if you're not, if you don't have buku money, do not trade NFP because you will blow your account. That's the one day of the month where people who make millions and thousands off the market literally go broke, like broke. They lose everything.
It's
And
insane.
Luke, I mean, I mean, you could agree with me on this, brother. Like people literally, like people who make 10 grand in a day trading Forex blow everything on NFP. It's insane.
Yep, I have I have a couple of people on here that they tried trading it before when they were brand new, had no idea what they were doing, and I'm telling you, man, I've never seen someone's face like go so white. Like NFP hits, NFP hits, and it cleared in seconds.
Uh, yeah, it's a scary thing to yeah, I mean, you guys watch the market. I mean, this is what I tell everyone is like, don't trade NFP, but watch what happens during NFP. Like, look at the pairs, and guys, remember what we talked about. Remember the source for all of our for what it is that we look at. All right, when it comes to like NFP, looking at like big events that's going to happen in the market. We're going to you pay attention to the currencies, you pay attention to what's going to happen, like the news, and yeah, NFP happens at the beginning of every single month, and you will see if you go to forexfactory.com, you see that you look at the news at the events, and you're going to see over here that it will mention non-farm payroll, something like that, very similar, and that's pretty much telling you let's go back, let's backtrack, because I think a lot of people want a clear understanding on what NFP is right now. So let's backtrack a little bit, okay? So February, the beginning of the month, right? Where is it? Luke, do you remember what day NFP was this month? Does anybody know if anybody was paying attention to NFP when the month began? Let me try to find out. Yeah, it's very similar to the all right, so yeah, I mean, I'm literally just skimming through this, so I can't really find it right off the here we go. Here we go. Here we go. Yes, it was the 5th. Yeah, it was the 5th. So here's NFP, guys. This is what it is, right? Non-farm employment change happens at the beginning of every single month, all right? So that's NFP right there, and look at what you're looking. Look, you see this currency here, the US dollar, major news, major impact expectations. Everyone is expecting a major impact in the market for the US dollar, the Canadian dollar. So obviously when you look at NFP, you know that something big is going to happen. These currencies are going to have a huge impact in the market. So like I said before, people blow out their accounts, people make thousands of dollars, people just, it's the one day of the month where money goes all over the place. Well, yes and no, because sometimes what would happen is if you have a stop loss, and let's say you have a tight stop loss, the thing is with NFP, price literally jumps so fast that sometimes it doesn't even, it just passes your stop loss so fast, and you get stopped out later than you should have. So you
Or
end up losing.
also right before it comes out, it's gonna fake one direction and then shoot the other. So you have to really be careful. You could have a stop loss and then it goes in your favor, but that could be a fake and then it shoots and hits your stop loss anyways. So you just have to. I mean, I don't trade it. I don't recommend trading NFP for anybody. But normally
Yeah.
after it closes, after about 3 or 4 candlesticks, it'll begin to retrace some. It normally retraces like 30 to 50%, and you can get in on the back side of it if you wanted to, which is normally where I make my money on NFP, but definitely not on the first part.
Yeah, guys, if you haven't noticed, also right after NFP, that's when WG starts to send out so many trade alerts, because that's when, like, once you see what the market does after NFP, it's like, I mean, once you see what the market does during NFP, you're looking at it afterwards, and you're able to get a better, you're able to understand a lot better where the price is starting to go. So definitely, that's what excites me about NFPs, all those nice trade alerts that we get. Yeah, so real quick, guys, I want to just touch on, yeah, just ignore what I have on my chart here, the resistance, support, that's stuff that I'm learning right now, though, so I was just, doing some, research on that. But what I want to talk about tonight real quick is about this indicator that was one of the first indicators that I used when I started trading Forex. And if I had not honestly relied on this 100%, I would have probably not have blown my accounts. But at the end of the day, this is a pretty good indicator as far as you understanding pretty much where price is going, what it's been doing, and looking for either buy positions or sell positions. So when it comes to this indicator, first I'm going to show you guys how to add it on your screen, and then we're going to talk a little bit more about what it's useful for. Right, so I'm going to show you guys. I'm going to demonstrate how you can add this. So if is there anybody actually on here right now who is on their desktop, who has their MetaTrader 4 open on either a desktop or on a tablet, or or on a laptop? If there is, okay, awesome, great. So I wouldn't be the only one doing this. Awesome. So all right, cool. So pretty much to apply this indicator, it's called the Stochastic Oscillator. That's what it's called. What you're going to do is you're going to go to the top left of your MetaTrader 4 platform. You're going to go to Insert. Okay. You're going to go to Indicators, down to where you see Oscillators. It's going to open up like a little chart there, and you're going to go to the second to last option, which is the Stochastic Oscillator. All right, so then you're going to open up, it's going to open up like this little window here, all right, with like options, K percent period and D percent period. We'll talk about that in just a second. And pretty much what this indicator is pretty much useful for. It's useful for pretty much helping you find better buy entries and sell entries. Now, a lot of people get this confused. They think they will tell you that the stochastic oscillator is going to tell you what will happen in the market, but I do not agree with that statement. All right, and this is like I tell everyone at the end of the day, indicators are not reliable as far as telling you what the market is going to do. But they are reliable as far as giving you information as to what the market already has been doing. So let's just finish plugging this in, right? Let's say blue. You could have blue, signal red. You know what? Yeah, everyone you could set it. You could have the same settings. It'd be a lot easier to understand that way. Yeah, so the main, you would have blue. Signal, you would have it as red. Levels, there's 3 levels, all right? You have the 20%, you have 80%, and you have the 50%. So that's what you're going to do. You're going to add on if you only have the 50% or the 80%, you're going to add the 20%. If you only have the 20% and the 80%, you're going to add on the 50%. All right? Just make sure you have these 3 levels, and that's pretty much it. Parameters, K percent period is 100, D percent period is 3, and once you have those settings up, you're going to click OK, and this is literally what you should have. All right. Now with the stochastic oscillator, the reason why I actually stopped using it, but I'm actually getting back into it. The reason why it's actually useful, parameters. Sorry about that. Kind of closed that too quick. Here we go. There's the parameters. I'll leave this up while I talk about this. So for the stochastic oscillator, the reason why I find it very useful as far as looking for buy positions and sell positions is because the stochastic oscillator, there's 3 different levels, or I should say, yes, 3 different levels that you're looking at for this indicator that's helping you determine what price has been doing and what it might be where price might be headed. So let's say the three levels that we have right here is obviously the 80%, the 20%, and the 50%, right? So what I tell people is when you're looking at the stochastic oscillator, you're pretty much paying attention to the 50% level. And the reason for that is we all at this, does everyone here understand about support and resistance at this point? This is like what our sixth webinar, I think, or our fifth. Does everyone know? Like, if we have anyone new, then I understand if you don't. But for everyone else here who has already been to the previous webinars, do you guys already understand support and resistance? Okay. Well, if you're new, welcome. Very excited to have you here. I'm looking forward to welcome. Looking forward to continue to learn with you, because as you know, we're not experts here, but we try to do our best with sharing the value. But yeah, awesome. Welcome. If you're new, absolutely excited to have you on here, have you on board. So quick message to those of you who are new, because I have to say this as the same way I say it on pretty much every other webinar. If you're new, and for those of you who are new, what you want to do after you watch this webinar is you pretty much want to go back to the very first webinar that we've ever had, and you want to just be caught up to date on everything. All right, so there you go. My man has it right there, nesvquez.com. All the videos from A to Z, from the beginning for our very first webinar that we've ever had to the one that we're having tonight. All right, all those videos have been recorded. The webinars have been recorded and saved and uploaded for you guys. So if there's any if you want to go back to that and get caught up on everything, please do so. All right. So now, for everybody else, the more advanced students who are on here, you obviously know about support and resistance. And what I look at when I'm looking at these three levels is I'm looking at support and resistance. That's all it really is. Absolutely, you want to take notes. Hey, right on the dot. You got it, man. So when you're looking at these the stochastic oscillator, you're paying attention to support and resistance. So the 80% for me, right? The 80% level, I consider that resistance. 50% I consider that resistance, and 20% I consider that support. Also depends on what price has been doing, right? So everybody knows that what comes up must come down. What comes down must come up, right? Price will never go straight up, and price will never go straight down. Now, let me give you guys a real quick quiz. Does anybody know why price never goes straight up? Or why price never goes straight down? Does anybody know why that happens? Price will never go straight up, and it'll never go straight down. Why does that happen? What do we see happens in the market? If you're new, you don't have to worry. You don't have to answer this. So no, Jared, stop cheating. That has nothing to do with what I'm saying. Yeah, exactly. Yeah, Bulls against the Bears. Exactly. So what happens is when you have when you're looking at the reason why we don't have either uptrend, straight price never goes straight up or price never goes straight down. There you go. Psychology. You guys are hitting it on this. Woo, you guys are on point today. I love it. Yeah. So pretty much price has to always come back. It always has to pull back. It always has to retrace. Has to reverse. What happens is if you're they will always be posted on the WG Forex group. Always. Yeah, so with the what happens is when you're looking at price, let's say for example, give you guys a quick example, right? I'm not going to dive into supply and demand tonight because like I said, I'm still learning about this as well myself. So with let's say right here at this example, everyone's looking at the left right now, right? If you were to buy, right, on this pair, if you were to buy this currency pair, you would have wrote it up, right? What would have happened is you would have seen these pullbacks happen. You see how price goes up and it actually has this pullback, and the reason for that is because while you're buying, remember, this is a global market. Millions of people have access to it. Billions of people have access to it, right? Just like billions of people, just like yourself, have access to this platform. So while you're buying, you're going to have people that are selling, people that are just selling. They just sell it because they want to sell it, right? You may know what you're doing, but the other person may not, and vice versa, right? So when you're buying, there's always going to be people that are selling. doing the opposite of what you're doing. And that's what creates those pullbacks. That's what creates those reversals. That's what creates those retracements. You can call it whatever you want to call it, retracements, pullback, reversals, but that's what creates that with price. This is literally the indicator that I have right now. It's the stochastic and the standard moving average. But back to the stochastic, you know, I consider this like support and resistance. So what happens is, like I said before, what comes up must come down. When price reaches a certain level, for example, 50 is obviously half of, you know, 100. So what happens with this is I look at how price is breaking through my 50%, because remember I told you guys earlier that I pay more attention to the 50% than anything, right? What happens is when price breaks that 50%, I know it has to come back down. But because it's still above, I'm going to look for buy entries, because I know that when it's above 50%, it's going up. Like Luke said this before, you don't want to trade against the trend. You trade with the trend, because the trend is your friend until a new trend forms, right? So you could do this, you could follow this, and you're literally following the data that this indicator is giving you. You're not going against it. So when price breaks this 50%, right? When price is breaking that 50%, you're obviously not going to say to yourself, let me look to buy this pair. No, you're looking for buy entries because price is heading upwards. Well, Josh, then how do I know when to sell? Here's how you know when to sell. Because if price breaks the 80%, right? 80% is a lot bigger than just the 50%. When price is breaking that 80%, you know that it's hitting a level, a strong level of resistance, meaning that at some point it has to come back down, right? And this is literally what we're seeing. My screen share is from. Can everybody see my screen? Like, did my screen freeze for anyone? I'm like moving around my my thing right now. You guys, okay, you could see. All right. So if anyone's having difficulty seeing my screen, I recommend trying to re-plug into the webinar. Maybe that will fix your issue. All right. But thanks for definitely bringing that up. Appreciate that. But back to this, guys. Like I said, when price goes above the 80%, I know it has to come back down. So am I going to look to trade when it's above the 80%? No, because at this point, I'm waiting. I'm being patient, and I'm waiting for confirmation for price to come back down. Guys, what would you? Let me ask you guys this. For those of you who are paying attention, what would you have done if price broke below the 80%? Over here, where my mouse is moving, what would you have done? Or what would you have looked to do in the market if you see that price broke below 80%? Right, right. You would look for sell entries. You're selling because you see that price is going down. You're trading with the trend, not against it. And obviously, you see it live right here, how the price literally dropped, right? Price has been dropping long term. Looking at the 4-hour time frame, price has been dropping. So you're looking for good sell entries, right? You can get in on the pullbacks, because remember, there's always going to be people trading against you. Take advantage of that, right? Take advantage of it. So those are pullbacks. You can get in on the pullbacks, right? Continue to write it down. If you miss a good entry, you can catch another one on the pullback. Write it down, right? There you go. No newer highs. Has to create lows. Has to create lows. Yes, absolutely. So, guys, just ignore this. Where you just ignore like the resistance support. Don't pay attention to that. That's like irrelevant right now. I should have deleted that. But like I said, I'm just kind of learning on that right now. But yeah. So you're paying attention to the 80%. Once price breaks above the 80% level, you're looking to you're patiently waiting for price to break below that 80% so you can sell. Now, breaks below, obviously if price breaks below the 50%, what are we going to look to do? If price breaks below the 50%, what are we doing, guys? If it breaks below, some people say buy, some people say sell. If it's all right, so I asked, all right, so earlier I asked if price breaks below the 80%, you would sell, right? So if price is breaking below the 50%, you would sell, because you see that price is still going down. It's not going to be coming up anytime soon. So for those of you who said buy, that's pretty much why you would not buy, because you're trading with the trend, not against it. But check this out. When price breaks below the 20%, which is like the lowest level, right, that we have, When it hits, exactly, there you go, man. You got all the answers tonight. You got to let everybody else answer, bro. It's not fair. But when price breaks below the 20%, you're waiting for a good buy entry, because at that point you see that price has to come back up, right? 20% is the lowest level for the stochastic oscillator that you want to use. So when it's below that 20%, the same way that price went above the 80%, you're looking not to trade around this area. You're looking not to trade around this area as well. You want confirmation that price is going to start moving upwards. So what do? Let me wait until price breaks above the 20% for me to look for a good buy entry. Now, some of you might want to ask me, well, Josh, can we buy this right now since it's live? No, because it's Sundays. Sunday's trap day. Even if you're 110,000% sure that you know what's going to happen, you still don't want to trade because price is barely moving, right? But just to give you guys a general example, that's pretty much what this indicator is known for. That's why it's so useful, so powerful. And it's giving you all that data. It's literally telling you what price has been doing. It's reached a high level of resistance, reached a high level, a strong level of support. And of course, as I mentioned, what comes up must come down, vice versa. Does everybody understand how that stochastic oscillator works? Does everybody understand the different levels and what those levels, what those levels mean? So you guys got a better understanding on that indicator? Great. So one thing I want you guys to understand is please do not do yourselves a favor. You're not doing this for me. You're doing this for yourself. Yeah, I mean, even if you're new, what's the better time frames to look at? So, yes. Oh man. All right, I'm gonna answer some questions because there's a lot of questions. Feel free to help me out with this, Luke. There's a lot of questions here. So what is the better time frames to look at and follow these indicators with? The indicator can be applied to literally any time frame. Of course, though, remember that if no one's told you this yet, I'm going to be the first one to tell you. And what I'm going to tell you is that the further the time frames you're looking at, the more data the market is giving you, the more data the market is providing for you to look at, which is why I always like to look at long-term trading, because the more data that I'm looking at, the better my trades will be, the more confident I'll feel about placing my trades, right? So you obviously who wants to see more, who wants to have more data in their chart? Who wants to look at more data, right?
Absolutely.
Bollinger Bands, I've heard that those are good indicators as well. There's not really much I can tell you about Bollinger Bands.
I'm a beast at Bollinger Bands.
Yeah, awesome. I mean, feel free to touch on that, bro. I don't really use those.
Let's try and answer up some questions. Okay, so what's the better time frames? Yeah. I mean, I normally look at 1 hour, 4 hour, or day charts, to get a good feel for it. Is there a way to set the indicator for all pairs at once, or do you have to do them individually?
You can. This is
No,
for all pairs. All
for
pairs. You see how you change your screen? You can change your screen to any other pair. Boom, boom, boom. So you can, it's the same thing applies to all pairs.
Awesome. And then, can you trade the London market on Sunday? Can you? Yes. But as we've been saying throughout this webinar, should you? No. And the reason is, I mean, the market's really not moving that much, so I wouldn't expect much from it. If you are, I mean, a couple pips here and there, but you're not going to be looking for serious profits or anything.
Yeah.
Would you recommend combining stochastic with Bollinger Bands? Okay, so Eric, to answer that question, there's a lot of good indicators out there, and you can really master a lot of them. However, what a lot of beginners do, I said a lot so many times, a lot of times, but what many beginner traders do is they fill up their whole entire screen with 3, 4, 5 different indicators, and it really gets overwhelming. You're gonna have so much on your screen that you really, they're gonna start, it's hard to determine a trend. They're gonna get really confusing and out of hand. So I would say, you really could just focus on, one or two and really master those. In the same way with trading a currency, choose one currency pair at a time that you want to trade. Don't try and trade 4 different currency pairs at the same time. Same thing with indicators is I would just focus on, 1 or 2 at a time. so that you don't get overwhelmed and confused. No, don't trade on Sundays. All right. Will you guys touch on Fibonacci's? Someone asked, will we touch on Fibonacci's?
Yeah, I mean, for like I said on our next session, we could definitely cover that. I mean, I've used Fibonacci retracements before. Very useful, actually. Very, very useful.
Yeah. Well, yeah. The next webinar we can do that. We can focus the next one on indicators, and I can definitely go over Bollinger Bands. You can go over the fibs and a couple other things that we use. So that would be a good one for another time. I want to try and keep this as focused as possible for today. Okay, so looking at bigger times for accurate trends and smaller time frames for more accurate buy or sell splits. Samuel, I mean, when you have a longer time frame, you're going to have, like you said, a lot more information, so you can get the larger picture of what's going on. If you are looking at a 5-minute or 15-minute chart, then you can get in and out of some trades and make profits. However, you're looking at such a small amount of time, a small amount of data, that it's not a long-term trend. So what you see, how right now is on the 1-minute chart, it might look like it's going on an upwards trend here, but if he goes out to, maybe the 4-hour or the day chart, it could say that it's, definitely a downwards trend. So, looking at the shorter time frames, it's really not going to give you the answer for what's going on in the market. It's only going to give you an answer for what's going on at this current time. So you wouldn't be able to, place a long-term trade and catch a serious amount of movement in the market if you're only looking at a very small time frame chart, if that makes sense. Yeah, 1 minute equals don't do it. Definitely. I've never trade the 1 minute. Totally agree.
Yeah, it'll get your adrenaline pumping. The 1 minute chart is really for like people who I mean, okay, here's the if you want to trade the 1 minute chart, you got to be really good at scalping. Just because that's all it really is. You're literally you're getting into the market for a couple of minutes and you're getting out. That's what it is. But if you wanna, my thing is conservative trading, right? Holding positions for multiple hours or multiple days is where the big bucks are at. Because you imagine, just think about this for a second. If you were to place a penny on Monday night, right, heading into London for Tuesday, and you let that penny ride out for until midweek, right? Um, and you let that penny ride out to like midweek for like Tuesday, like Wednesday night or Thursday, you're turning a penny lot, a micro lot into like what, a good 20, 30 bucks. You know what I mean? So that's why for me long-term trading is just great. It's phenomenal. I love it because you're just like looking at better, more distant time frames, and you're looking for good entries, whether it's buy or sell entries. But yeah, that's what the stochastic oscillator is very good for. Definitely helps you find better sell entries and buy entries for sure. Yeah, I like to look at the 15-minute to be honest. When I look at the 15-minute, and I look at the 15-minute chart and I look at what the previous two 15-minute candles have been doing. If they are both not giving me enough information as to what might occur next, I'm going to make sure I don't trade yet. But looking at something like this, where I can easily place my trend line and say, hey, look, this is going on in an uptrend, and it doesn't look like it's coming down anytime soon. What I would do is I would wait for price to drop just a little more, a couple more pips, right near this level of support right here on this trend line, right in this standard moving average, and bounce right back up, and I would ride the wave back up. Because it was not this. A new trend is not going to form on a Sunday, and it's not going to form on a Monday. That's not going to happen, right? You want to trade with the trend. You see, obviously, we all see that this is an upwards trend, right? So you would look for a good position to buy. Now you're probably saying to yourself, well, on the stochastic, it's above the 80%. So why are you telling me to buy if it has to come back down, right? Well, that's when I'm telling you that the stochastic oscillator will never tell you what will happen. It's only telling you what is already happening in the market, all right? So it's something to always be aware of. How does Sunday affect swing trades? I would say if you've been on a swing trade, let's say from the past week, and you're still holding on to that, Sunday would really only affect it as far as gap trading goes. As far as when the gaps open, the spreads go crazy and your profit might go into a negative, but then later on you see that you might be in profits again. That's typically what happens. And I tell people, don't worry if that's what happens to a position that you've been holding since last week. If you're in profits and all of a sudden you hit negative, it's because the gaps that open in the market, like I said, and like the spreads go crazy, the gaps are like, all over the place. Gaps have to get filled and everything, so your profits might just go into negatives for maybe that remainder of the night. You wake up again tomorrow, might be in profits, you know what I mean? So that's just something to take into consideration. Don't freak out if you've been in profits last week and all of a sudden you're in negatives now, especially if it's not a big if you're not in a big negative, then it's nothing to really um, you know be scared of or anything. But I do hope that you guys were able to learn how to use this stochastic oscillator indicator, and I hope that it really is beneficial to you guys from this day on forward, and you can actually apply this to your trading, especially when we have the live trading webinars from now on. So I definitely, like I said, I hope this was very useful to you guys. I definitely appreciate every single one of you for plugging into this webinar. For those of you who are new, again, you're welcome. Welcome to have to be here. It's an honor to have you here, to be working with you guys. I absolutely look forward to learning more with each and every single one of you, and I look forward to actually having more people, on this webinar and these educational webinars, sharing their information, sharing their knowledge. Because at the end of the day, is what I tell everyone. You have a lot of people putting in a little amount of effort. We can really turn something like this we can manifest this. We can turn this into something gigantic. You know what I mean? Especially for our live trading webinar. So. Yeah, that's pretty much all I got for you guys tonight. It was an absolute pleasure to be here. Luke, thanks a lot for having me, brother. And I'll pass it right back to you, man.
Absolutely, Josh, you killed it as always. I really appreciate you hopping on here and your consistency and everything. You're really just helping everybody win. And like you said, the people that are getting on here, I'm sitting here scrolling throughout the attendees the whole entire time during these webinars, and I see a lot of people on here that are consistently getting on our webinars. A lot of the same faces showing up, and we also had a lot of new people this time too, which I highly encourage you guys to go to nesvquez.com and check out all of our other recordings so you can check out so you can get caught up. But guys, for those of you that are returning to these webinars and you really find value and you're really wanting to learn more about the markets and things like that, if you guys are doing well on your own, reach out to me, and we could have you featured on here and you can share what you know as well. Everyone helps everyone here, but it's really your responsibility. The effort of Josh and I to get the word out about these webinars is just two people. But if we have 40, 50, 60, 70 people on here and all of us are promoting these things, then we can really start packing these webinars and getting a lot more people on here, helping a lot more people, and just learning a lot faster the more people that we have on here. So these questions that you guys ask are also not only to help you with answering your questions, but it also helps Josh and I to improve and sharpen our skills and grow as a better trader. So this helps everybody win both ways. I appreciate all of you. For the next webinar, it's going to be tomorrow morning at 10 a.m. We have a live session with our experts, and then Tuesday night will be a live trading session for qualified generators only. If you're not already in the qualified generator chat room, you need to reach out to one of your uplines and they need to send me your name so that I can add you to that list. Qualified generators only get to trade live with us twice a week, Tuesdays and Thursdays. So guys, thank you so much for your time. I hope you have a blessed night, and yeah, have a good night. Until next time, take care.